When it comes to investing, or even life in general, playing great offense isn't enough. You need a solid defense. In other words, avoiding big losses is just as important as making big gains. The Oracle of Omaha built his fortune not just by picking winners, but by avoiding disasters and managing risk at every turn. In today's video, we'll break down Buffett's top 8 quotes on risk management. Get ready for some timeless wisdom that can help you invest smarter and sleep easier, even if you're not a financial expert. Let's dive in. Never test the depth of the water with both feet. In plain speak, don't jump into something head first until you're sure it's safe. If you're crossing a river and you're not certain how deep it is, you'd first dip a toe or one foot, not plunge in with both. Buffett uses this saying to warn against all or nothing bets. It's a folksy way of saying, try a small step before you commit completely. For investors, this means you shouldn't put all your money into a single new idea or stock without testing the waters. Even Buffett, known for big concentrated investments, always ensures he can handle the worst-case scenario. For instance, when he started buying shares of Apple in 2016, he didn't immediately throw in all his capital. Berkshire built up the position over time. By not going all in overnight, he could learn more as he went. Similarly, if you're exploring a new business venture or career move, Buffett's wisdom suggests starting small or slowly until you know it's a sure thing. That way, a misstep won't sink you. The takeaway: test things out gradually. Whether it's an investment, a business, or any risky decision, consider taking a partial step first. Avoid irreversible, high-stakes leaps when you're unsure. By wading in carefully instead of cannonballing, you limit potential damage and can adjust your course with much less pain. Risk comes from not knowing what you're doing. Imagine you're about to explore a dark cave without a flashlight or a map. Sounds risky, right? In investing and life, ignorance is risk. This Buffett quote underlines that the less you understand an investment, the more dangerous it can be. On the flip side, if you do your homework and know the terrain, you significantly reduce the chance of nasty surprises. A little research can turn a risky guess into a calculated decision. Buffett learned this early. As a young investor, he was obsessed with studying companies. Famously, he avoided the late 90s dot-com stock craze because he didn't truly understand those new tech businesses. While many people were blindly pouring money into internet companies they'd never researched and later got burned, Buffett sat it out. He stuck to what he knew: businesses with real profits and clear models. Another example, Buffett's first major investment in the mid-1950s was GEICO Insurance, a company he understood deeply after diligent study. That knowledge gave him confidence to invest heavily, and it paid off for decades. In his view, knowledge and research are the best antidotes to risk. Never invest in a business or project you don't fully understand. Take the time to educate yourself, read, ask questions, analyze. As Buffett implies, risk shrinks with knowledge. If something seems too complex or murky, approach with caution or not at all. Only when the tide goes out do you discover who's been swimming naked. This colorful metaphor paints a vivid picture. When the ocean tide is high, everyone looks like a great swimmer. But when the water recedes, those who weren't wearing swimsuits or taking precautions are suddenly exposed. In financial terms, good times can hide bad risks. You might not see who's overextended or reckless until a downturn reveals the truth. Buffett's point is that you discover who's been taking undue risks only when conditions get tough. We saw this during the 2008 crash. Before the crisis, banks and investors were making lots of money and everything seemed fine. The tide was in. Once the market crashed, it became clear many institutions had been swimming naked by taking on too much debt and mortgage risk. Lehman Brothers, for example, collapsed because its risky bets were exposed. On the other hand, companies with conservative finances survived. Buffett had been warning about the dangers of heavy debt. When the tide went out, Berkshire Hathaway wasn't caught naked. It had plenty of cash and safe assets. Another recent example. When the pandemic hit in 2020, some businesses that had binged on cheap loans suddenly struggled or went bankrupt, whereas those with rainy day funds endured the storm. Buffett loves this quote because it reminds us that true risk management, or lack of it, becomes visible in a crisis. So, don't be the swimmer who's naked when the tide goes out. In good times, it's tempting to ignore risk and leverage up, but eventually the cycle turns. Buffett advises building your business or portfolio to withstand the bad times. That means keeping some safety buffer, like cash or manageable debt, so that you're still covered when the tide inevitably recedes. Never risk what you have and need for what you don't have and don't need. Think of a gambler who has the money for next month's rent in his pocket, but he's eyeing a fancy new sports car he doesn't really need. If he bets his rent money trying to get the car, that's a terrible trade-off. Buffett's quote is a reminder to never gamble essential resources for non-essential rewards. The potential gain isn't worth the risk of ruin. In life and investing, preserve your foundation before you reach for something extra. Warren Buffett often warns against reckless risk, especially when people are already well off. A famous example he gave was the collapse of a hedge fund called Long-Term Capital Management in 1998. It was run by some of the smartest investors on earth, even two Nobel Prize winners who already had substantial personal wealth. Yet they made huge leveraged bets to chase even more gains. When those bets went south, the fund imploded, nearly taking down the financial system. As Buffett put it, to make money they didn't have and didn't need, they risked what they did have and did need. He called that plain foolish, no matter how high your IQ. Similarly, Buffett refuses to over-leverage Berkshire Hathaway or risk its core capital for a quick profit. He's happy to forego opportunities if they require putting what's important at stake. After all, he wants to sleep well at night, and you can't do that if you've bet the farm. The takeaway: if an investment or decision could jeopardize your basic well-being or your company's survival, don't do it, no matter what upside is promised. There's no sense in risking something you need for something you want. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Picture a ship captain who's obsessed with avoiding rocks more than catching the wind. He knows that one bad crash can sink the ship, no matter how fast it sailed before. In the same way, Buffett's first rule is all about not sinking, preserving your capital at all costs. If you lose half your money, you need a 100% gain just to get back to even, which is a tough hole to climb out of. So instead of swinging for every home run, Buffett focuses first on avoiding big mistakes that could set him back. A real-life example? Think about the 2008 financial crisis. While many big banks had piled on risk and ended up needing bailouts, Buffett's company, Berkshire Hathaway, stayed solvent and even had cash ready to invest. Buffett had refused to over-leverage or bet the farm during the boom years. In fact, he likes to quote an old race car adage, "To finish first, you must first finish." By always planning to survive the worst-case scenario, he could take advantage of opportunities while others were bleeding. When others were losing money, Buffett was in a position to lend $5 billion to Goldman Sachs on favorable terms, a deal that later earned Berkshire a $3 billion profit. His cautious strategy paid off because he never forgot rule number 1. The takeaway: protect your downside. Before you chase a big win, make sure a loss won't wipe you out. It's better to grow slowly than to risk blowing up your finances. In Buffett's words, achieving success starts with not courting disaster. The most important thing to do if you find yourself in a hole is to stop digging. If you've ever made a mistake and tried to fix it by doubling down, you know how badly that can go. Buffett's whole quote is straightforward wisdom. When you're in trouble, don't make it worse. Stop, reassess, and cut your losses instead of throwing good money or effort after bad. It's like realizing your route is wrong. The sooner you quit going the wrong way, the sooner you can get back on track. Buffett has applied this to his business decisions. Early in his career, he invested in a struggling textile company, Berkshire Hathaway itself, back when it was just a textile maker. For years, he tried to revive the failing textile operations, pouring in money for new equipment, but the industry kept declining. Finally, in 1985, he stopped digging. He shut down the textile mills to prevent further losses. Buffett later admitted he should have done it sooner. Another example, when Buffett realized his investment in Tesco, a UK grocery chain, was a mistake, he sold out rather than cling on in hopes of a turnaround. It's not easy to admit a bad decision, but Buffett's success is partly due to quickly cutting loose the losers. In contrast, many investors ride losing stocks all the way down, hoping they'll bounce back. Pride and hope can tempt us to keep pouring resources into a losing cause. Buffett's advice: don't. Learn to pull the plug when the evidence says a project or investment isn't working. By stopping the bleeding early, you conserve energy and capital to fight another day, just as Buffett does. Diversification is protection against ignorance. It makes little sense if you know what you are doing. At first, this quote might sound counterintuitive because most of us here don't put all your eggs in one basket. But Buffett is making a nuanced point. Diversifying, spreading your money across many investments, is a way to protect yourself when you aren't sure what's best. If you don't really understand your investments, holding a bit of everything limits the damage from any one failure. However, if you do have high conviction and knowledge about a few opportunities, Buffett argues that too much diversification can dilute your results. It's like a master chef who confidently specializes in a few great dishes rather than cooking every item on the menu. Buffett practices what he preaches. Berkshire Hathaway's stock portfolio is relatively focused. A few big bets make up the bulk of its holdings because he buys only what he deeply understands. For example, a single stock, Apple, recently comprised about 40% of Berkshire's portfolio, a huge concentration. Buffett was comfortable with that because he studied Apple and believed in its long-term value. In contrast, an index fund, which Buffett actually recommends for most people, holds hundreds of stocks to protect investors who don't analyze individual businesses. The key is that Buffett only skips diversification when he has done the homework and is extremely confident in a particular investment. He knows what he's doing, so he's willing to put more eggs in those few best baskets. The takeaway: diversification is a handy safety net for ordinary investors, and Buffett agrees most people should use it. But Buffett's quote reminds us that if you truly know an investment is great, you don't need to own 50 different things. In short, know your circle of competence. If you're sure of something, it's okay to bet bigger on it, but if you're not sure, then spread your bets. Predicting rain doesn't count, building arks does. This quote is often called Buffett's Noah rule, referring to the biblical story of Noah's Ark. The message: it's not enough to predict problems, you need to prepare for them. In other words, anyone can say a storm is coming, but the real winners are those who have built a sturdy boat ahead of time. In finance, that means don't pat yourself on the back for warning about a market crash. Instead, set up your portfolio so you can survive or even thrive if it happens. Throughout his career, Buffett has been more ark builder than rain predictor. Take the period before the 2008 financial crisis. Buffett didn't claim he could forecast the exact timing of a crash, but he did make sure Berkshire Hathaway had a huge cash reserve and conservative investments going into it. When the rain came, Berkshire was ready. Buffett famously deployed billions to shore up Goldman Sachs and other firms on favorable terms, essentially using his ark when others were drowning. Another example: Buffett's insurance companies always keep ample float, insurance premiums set aside, to pay claims even in worst-case disasters, plus extra capital just in case. He prepares for market downturns and economic storms rather than trying to guess exactly when they'll hit. This approach has kept Berkshire financially solid through crashes, dot-com busts, and pandemics alike. The takeaway: preparation beats prediction. Instead of obsessing over when the next market crash or rainy day will come, focus on building your ark, an all-weather strategy. That could mean keeping some cash for emergencies, diversifying enough to handle storms, or investing with a margin of safety. Buffett shows that the investors who survive and prosper aren't those who call every downturn, but those who are ready for whatever comes.